Alright, welcome everybody. Welcome to part 3 of the JEC trading course. Today we're going to be building context. So, what this means, we're going to be building the context of our trade, whether it's short, long, price levels, what we're going to be looking at. So this is where it starts to get a little technical. We're going to have a little bit of fun, and let's just get right into it. First, we got to talk about candlestick charts. And to understand candlestick charts, which is what we'll be using to trade, we need to understand candlesticks. So first thing about candlesticks, each candle represents a certain period of time. So for example, let me get out a pen. This candle right here can be 5 seconds, right? So we have a 5-second candle, and this one right here, for example, could be 30 minutes. So this might mean it's 11:30 to 12. This could be 11:30.30 to 11:31. Oh, no, less 11:30.35. So that's 5 seconds. That's 30 minutes. Different time frames. So they represent different stuff. Now, the way to read a candle, it's very good to know this. It's actually essential to notice. So when we look at the green candle, the low price is right here. So that's the lowest price it reached within that 5-second period. And then the high price is right here. That's the highest price it reached during that 5-second period. There's the opening price of this candle, which is the price that it opened at. So that's right here. The price that it opened at. And there's the closing price of the candle, which is right there. So the reason it's green is because it closed above where it opened. Hence, it's green. It went up, right? Now looking at this red bar, you can probably guess how this is going to work out. There's the high price, which is right here, that stays the same. The low price stays the exact same, so lowest point of this 30-minute candle, highest point of this 30-minute candle. And remember, price fluctuations within a higher candle are probably going to be higher than a 5-second candle. So these numbers will be very close to each other, whereas in this 30-minute candle, they are probably further. So there's the opening price. Opening price of this candle right there, and there's the closing price of this candle right there. So as you can see, it closed below where it opened, hence it's a red bar. Alright, so you know a little about candlesticks. Let's talk about the top-down effort of trading. Alright, so what I mean by a top-down effort is when we're building our context, we start with a higher time frame. So we start with daily, weekly, monthly even, and we build the direction of that market before we actually build our thesis. So when we're building our context, for example, here's oil, the September 17th oil futures contract. This is a daily chart, and we've plotted some lines here. So as you can see, we plotted this trend line right here. This trend line going down right here. Oh wow, that does not look neat. Let's try it again. We're just gonna bracket it. So this trend line, that's the upper trend line, and the magnitude of this trend line tells us that we are in a technical downtrend. And we plotted the lower trend line right here. Again, the magnitude says that this is a long-term downtrend. Now, this chart is actually a bit old. If you look at oil right now, it's actually going up, but it hasn't broken this line yet. So it's still in a technical downtrend until we break that line. So again, you build your context at a high time frame. So I talked about trend lines. What trend lines are, they approximate the magnitude, the direction, and the position of the trend. So let's go one by one through magnitude, direction, and position, and I'll explain to you what I mean by each. Let's get a pen. The higher the slope of a trend line, the higher the magnitude is. So for example, if your trend is flat like that, then it's not really a trend. That's more of a price level. But if you have a very low magnitude trend like that, there's not that much strength. So this is not that bullish, and this would not be that bearish. But if your trend line looks like that or looks like this is very bullish and this is very bearish. So they approximate the magnitude and the direction. So if your trend line is going down, that's bearish. If it's going up, that's bullish. So if it's going down, you probably want to be short. If it's going up, you probably want to be long. So, and position. As you can see, there's this channel right here that is on CL September 17th contract. This was around August. As you can see, there was an approximate dollar range between these two, and we were mid-range right there. So if we shorted, there was a probable chance that we'd gain around 50 cents from that trade. I don't remember taking that trade, but that was my analysis on it. And this was a trade I did take. I was short. As you can see, my reasoning behind being short is we were close to the upper trend line, and I do remember this went down quite a bit. I think I closed this trade around 45.75, I'd like to say, but don't quote me on that. So they tell you where the position of the trend is. For example, if your price is near the trend line, then it's probably going to go down before it retraces. Now, very important is price levels, support and resistance. So, first of all, support is demand levels. When price touches a support level, there's high demand, so people buy it, it goes up. And usually these demand levels hold up throughout time. So if you look at a higher time frame, if we actually go back to this chart right here, you see I supported support lines, and this was 43.90. You can see it got bought up, it got bought up. Let's get the pen. It got bought right there, it got bought, it got bought. So that's a demand level. People want to buy it. And then there's resistance levels, which is where people want to sell. So if I actually draw an approximate trend line, like going right there, just imagine that's straight and it's leading to, I don't know, I'd say like 59 or something. That is a resistance level. You can see it gets sold right there, it gets sold right there, it gets sold right there. So these are supply levels. There's more supply than there is demand. And people go ahead and sell it and it goes down. So support and resistance are very important, and you want to have your support and resistance plotted on higher time frames. So when you look at the lower time frames, you know where your entry should be. These are used for entries, and good trading makes good use of support and resistance. Actually, it's the primary rotary point of good trading. So what I mean when I say higher time frame equals more weight, if it's tested multiple times on a high time frame, then it means a lot more if it's tested like twice on a low time frame. So, you know, the higher your time frame, so if you're looking at a daily chart, and as we did with this right here, it carries more weight than a 30-second chart. So round numbers are usually support or resistance. So if you're looking at gold 1263, 1264, 1265, these are all probable support or resistance. So look at those levels and you can find them. You can play with low time frame levels for scalping. So if you plot support and resistance on a low time frame, you can play with those, scalp around those levels. So if it's mid levels, so if it's between one price level and another price level, you can probably scalp that depending on the direction of the trend before it actually hits that level. So go ahead, and that's a liable trading strategy. We'll talk about that. Now, you don't want to overcomplicate. You don't want to plant too many trend lines. As you can see, this was a while ago actually. I don't quite remember when this was, but I wasn't too proficient in what I was doing. So you can see I was putting way too many trend lines, and they were completely irrelevant trend lines. It did not help with trading. But as I got better, you can see I had very few trend lines, and I was up about $5 on gold right here, which is $500 on the contract. So this was a good trade at that point. So again, keeping it simple is the best way to go about it. Now, picking support and resistance, this is an important slide. You really want to look at this. So the support or resistance should be tested at least 2 to 3 times. This price level should not be tested once and you're like, okay, that's a support level, that's a resistance level. No, it should be tested at least 2 or 3 times, and it should go down on low volume. So you want to focus on high time frames. Remember what we said, the higher the time frame, the more weight that support or resistance level carries. You want to use levels to build your trade thesis. So this is primarily for your entry part of your thesis. You want to say, this is the level I'll be looking at, this is the level I'll be looking at, how it reacts off of these, and I want to get in at this level, above or below the reaction point. So you want to build your trade thesis using support and resistance. For example, $40 and $50 are high time frame support and resistance on CL, which is oil. From now on, we'll be saying CL. You should automatically know we're talking about oil contracts, oil futures. Now 40 is a support level, 50 is a resistance, so these are respectively lined up, and every time it hits around 40 it goes right back up, every time it hits 50 it goes right back down. So you can form your trade thesis and say, okay, price is hovering around $50, I am fairly sure that there's a more probable chance of it going down than going up, and you wait, it breaks 49 on high volume, so it's down $1 from 50. You say, okay, I'm going to short at this point, I'm going to put my risk 20 ticks from here, and I'm going to ride this until 44. There you go, that's your trade thesis. Or vice versa, it hits 40, you wait, it breaks 40.50, 41 on high volume, it's not going back down, and you say, I'm going to get long and I'll let go at $48. Bang, trade thesis. Alright, so volume. Volume is important. It should be an important part of your trading, and always look at volume when, especially for your entries and confirming support and resistance pivot points. So you want to use volume and support and resistance to confirm your thesis for entry. This was the little analogy I gave in the previous slide. So if you're at a support level, for example, $40 on oil, high volume, buying happens, you're like, okay, this is confirmed, I'm going to wait for another level to break, and then I'm going to buy, I'm going to get long on this trade. So you're confirming your thesis. General rules of thumb, if there's a high volume sell-off at a resistance point and a downtrend on a high time frame, means you should be short. So what this means, for example, say oil's in a downtrend, which is it is. I talk a lot about oil is because I'm primarily an oil trader. So say CL is in a downtrend, which at the moment it is, so this part of the equation holds on a time frame, and we get to a resistance level of $50, there's a high volume sell-off, then my probable trade thesis is short. I wait for more price levels to break, then I get short, I get a nice entry, good risk management, that's my trade. Now if there's high volume buying at a support plus an uptrend in a high time frame, so for example gold, you want to swing gold and you're at a support level, there's a lot of buying happening, people want to buy this contract, then you probably want to get long. So that's your probable conclusion to build your thesis on. There's the trade building process. I'm going to explain this picture I've added here, and you're going to see why it makes sense. The trade building process is nothing short. It's not easy. You're going to see trading's not what they make it out to be in movies where it's like split-second decisions. No, it's very planned out. It's very organized, and it's very institutional. So you want to build your context, if it's long, if it's short, the price levels you'll be looking at, and then you want to decide your trade type. So if it's a scalp, if it's a position, if it's a swing, and remember, all of these should be in the direction of the market. So if your market is in a downtrend, then you should be scalping shorts, positioning shorts, swinging shorts. If it's in an uptrend, scalping longs, positioning longs, swinging longs. So, and then depending on the type of trade it is, you want to form your risk. So where your stop loss is going to be, while you're trading in the beginning, use a hard stop loss. But as you get more proficient, keep a mental stop loss and judge as the market goes on. But for the purpose of this course, we will use a hard stop loss. And there's a number of ticks risk, so that's your dollar amount. So for example, 10 ticks on CL, $100, or 1 point on gold, $100. That's your number of ticks risk and the risk reward. So if you're risking 1 point, $100 on a gold contract, you want at least 3 points. So $300 profit to maximize this trade. Point 4 is the most relevant to this picture. You want to hunt for your entry. This is important. You've built your conclusion, you've built your thesis, you know what you're looking for, what levels you're looking at, and you're just going to hunt. You're just going to snipe this trade. So you're looking deep. You can see how this guy is focused. He's not rushing. He doesn't want to get in the market too fast, or in his case, kill the deer too fast. He's waiting for the perfect lineup. And that's what you're going to do. You're a hunter. You're a trader now. You have to be focused. So you're going to hunt and hunt and hunt. And then at the exact moment that it feels right, that it looks right, and logically it's right, you're going to execute. And, best of luck at that point. Alright, this was a good video. I'll see you guys in the next video, which is going to be setting up the trading platform. And then after that, we're going to get into risk management. So it's been a lot of fun, and see you guys soon.